I made $1,683 trading JT strategy, and I'm going to show you the breakdown of the strategy so you can use it for your own, because it's very simple to learn. The most simplest trading strategy I ever saw in the industry. First of all, this is a 1 minute chart, and you can see here how I made $52, $800, $300, and $600 a week. And in total, it's here 1,683 trading only 8 hours of my time. Each time is just like 1 hour between trading session using color switches. I will show you how with I was trading here with quantity, the money management, and then also how I traded the color switches using the Anchored VWAP or 1-day VWAP. And I hope this will literally improve your trading. First of all, it is to understand with the money management that I only wanted to lose $200, $230-ish every day. And as you see here, I almost succeeded here with $236 of loss, $245 or $200. So $230 is around a range. I tried out 2 different kind of rule sets. The one rule set is to have only 2 losing trades. And the other rule set is to have so many losing trades that it's filling up $200. And it's literally better to have just 2 losing trades in a row and then stop trading, because it makes more sense with the money management. I'm going to show you how I traded with less quality, more with quantity, but still made money as you saw. And then how to find more qualitative trades to just have less trades, because it will be just more comfortable to have less trades, and that you see where trading opportunities makes way more sense. So here you can see how I traded a color switch, a green and a red candle. I adjusted it to $75. I lost $75 here. I lost $75 trading this color switch, this green and a red candle here. And then I made around like 700-ish, I think $500, $700 doing this trade here. And then the last trade that you can see here was just like, again, a losing trade of around $75. I'm going to explain you this trade. The money management is just the most important thing. This is what you can see here. When we scroll down here, you can see I lost $75. You can see I lost $75. And then on the last trade here, you can see how I made $700, $300. And then here it says $400 with the last trade. And then I was trying to punch in the last trade, and I was going out with minus $25. And I ended the day with $500 trading color switches. The next day I was trading, we're going to do this day, by the way. It's just like very important that you understand first what is a color switch, what is the 3-step process, and then what are 4 things to find more high qualitative trades that, for example, these losing trades that I have, you don't need to go through. So first of all, it is about the green and a red candle is always showing us that the market was pushing in the direction against us and then in our direction. That means green and a red candle for selling and red and a green candle for buying. On the right side, there is a timer that you can see here, the 20. And the timer counts down from 1 minute, because this is a 1 minute chart, and 3 seconds before the candle is closing or 2 seconds before the candle is closing to make the entry, and then to trade it. The color switch is very important. That means from the setup, there are color switches that are very long, and there are color switches that are tiny. And the smaller the color switch, the better, because when adjusting here now $100, as you see here or here, because I had a late entry, and then the stop placement here where my mouse is, when selling now so much that it's around $100 or 75, it depends on your money management. In this case, it was around 75, 65, like 50, 75-ish. I wanted to adjust, and sometimes $100, but usually it's like 75 in average for the losing, because here on the performance, you can see when going more higher, you can see here on the performance, it says like here 70, average losing trade was $72, but the average winning trade was $409. The worst trade was $130, and the best trade was $759. When going more up, you can see here the performance curve, how it looks like. And this is something that's very important when it comes to money management. And when going more higher, you can see here the average win and loss is 5.66, $409 of winning, $72 of losing. That means even though when having 22 losing trades and only 8 winning trades, still having $1,683 in the pocket. So what is very important is to find more high qualitative trades that color switches work better. Because as you saw here, I trade also green and red candles, but I get stopped out twice. And then suddenly it works here in the middle better, because this is a trend following trading strategy. That means that step number 1, you can see that the market is pushing and aiming for a specific high or low. This is a specific reference. A high and a low is when you see a spike here, when you see those bigger structure spikes here. A high and a low is also a color switch, such as a green and a red and a green candle. But when trading the 1 minute chart, it's more important to make the chart so small as possible and to see the outside structure. When we can see that the market is more near at the high than the low, or we can see that the market is clearly pushing somewhere specific, in this case, because we have here so many candles down here, I was assuming all the time since I started trading, this is also what I was showing here with this drawing here, that the market is a bit wiggling around, a bit spiking higher as you see here, and then starts to rotate lower, what I wanted to trade, right? And you can see also my trade also matched this line here that I was drawing in the background. This is an exercise I saw with beginners. It helps them a lot. First drawing in, how do they see the market? And then they trade how they had the first impression within the 15-ish minutes, what they can see within the market. That means they're always, in the beginning, there's always time, what is very important. Trading time should be a square, like here you can see. Market pressure, that means how do we see the market right now? Without seeing the candles in the background is very important. And then the third one is the references, that means the highs and the lows. When it comes to the 3-step procedure, those 3 things should be done in the beginning. In the first 5 to 10 minutes is very important. That means I'm going to take your chart and then I'm going to show you this one, that you can do this for your own trading. And then we're going over 2 more things, and I hope this improves, of course, your trading. That means we go here to the 1 minute chart, we go to the ES1 exclamation mark, E-mini S&P 500 future. Or you can also take the MES, for example. That means we put a trading square from here to here, that is 1 hour, for example. And when you put a trading, like here, a rectangle within 1 hour, and you cannot see the future, just compare the past a bit, what the market did. And when you see, this is something what's very important. When I'm here, for example, taking a screenshot here, and I'm comparing the last hour here, as you see here, this will be the last hour. It look like this. And if I'm just attaching it here, you can see here within 1 hour, within the same candles, the market should structure more lower. That means I should assume, this is the first one, is time. The second one, I should assume that the market is just like structuring lower. The third one is, I look to the left. What kind of structure do we have? Lows and highs, as you see here. This is a low, this is a high. The next reference, big reference, would be down here. That means just like from the structures, this is what the market is targeting at. And then when seeing that the market is going there, this is where we have this 3-step systematic. Step number 1 is always to see those references, that it makes sense that the market goes to a specific reference. This could be a consolidation phase. That means seeing on the left that the market is just wiggling around. That means, for example, up here when the market goes up, or down here when the market goes down. This is a consolidation phase. Next consolidation phase would be around here-ish, right? Just seeing where you see the market was wiggling around, had here a lot of candles. The second thing you can use also as target are just highs and lows, such here and there. The thing is just, you need always to compare bigger pressure, because when you see bigger pressure goes up, as you see here, usually it will reach highs and even shoot above. But when you trade down here in this case, usually it should not reach lows as you see here. It will just aim for consolidation phases. For example, here you see consolidation phase, and down here you see a medium structure low. And when trading down here, it will be more important to aim for the consolidation phase, because as you see here, the market is not reaching here the biggest structure low. That means on step number 1, identifying the high and the low, the lows, and seeing what makes sense is literally important to identify also, am I trading with pressure or am I trading against pressure? That means with pressure would be good to trade against a higher low. Against pressure, maybe a consolidation phase, or just from a bigger structure low, because look here, this is a bigger structure low. It will be better that when selling here, for example, would be just better to aim for a smaller structure low like here. There can be risk-reward ratio in money management. This is the most important thing to make the most amount of money in trading. I see, because you can have 20, 30 losing trades. You need just like 5 or 8 winning trades, as you just saw it. And this was $1,600 as I just showed you, right? So 3 steps. First thing is to identify highs and lows and the consolidation phases. Second one, Once you can see it makes sense, very important, that the market wants to go there. And you will see this through market experience. That means if you take a 1 minute chart, the MES or the ES, the S&P 500 future it's called, and you can see that the market is going there, then you want to see that the market does green candles, lots of green candles, for example, as you see here. Or you want to see, very important, that the market does more length up, right, than down. Or what you want to see is maybe that the market goes higher and starts, for example, in reference from here to here, you can see how the market does here more candles than down here. And it starts always to make more and more candles. The more candles the market does higher, the better is that the market feels confident trading in this area, as you see here, also in the future, just wiggling back and forth. That's the thing with the pressure. That means, for example, here, you can see how the market does here. Less candles, more candles, more candles, and then a bit less candles, right? But it still does more candles than for example, down here. Like always on the highest point, you see how the market does a lot of candles. And this shows us just a lot of pressure that the market wants to shift higher. And because we have here the most candles here in this area, we can expect actually that the market wants at least to spike one time back. The fourth thing is to see literally that when you make the chart, when you contract it very small, like you make the chart like this very small, I'm going to show you this one with TradingView. A lot of beginners and even advanced traders are not doing that. If you make the chart small like this, that you almost cannot see candles, you will see better the structure where the market is aiming at, as you see here and there. And you can also see way more better what makes sense with the current market pressure by just looking at it over and over again. If the market wants to go down here or up here. And if you see, for example, that the market is more near at the low, it will be better to aim at the low than, for example, for this bigger structure high. So having here losing trades, for example, is totally normal. It's normal to have losing trades. It's important to categorize the losing trades that you have, as I said, that you have seen the high or the low. That's step number one. Step number two has actually 4 categories. I'm going to break them down again in the end of this video, or like I can break them down also now. I think it's better. I think it will just break down now in step number 2 these 4 key points to see market pressure. That is, you see a lot of red or green candles in one string, for example. You have like 3 kind of strings. The one thing is, if I'm just removing here all the drawings, the one thing is in the last 10 to 20 candles. Sometimes it's just within the last 5 candles. The middle one is within the last 20 to 50 candles. And then the full one is the last 200 or like more candles, just like within today or the last 3 days even sometimes. And when you identify these 3 different things, that means you have actual pressure, you have the from the midterm, and you have the long term as if you use the 1 minute chart. Then sometimes one is stronger than the other, and this depends on, when looking at the market, which of these looks stronger right now. We're looking at this, you can see like the left one shows us there's strong pressure up. Middle one is showing us that it's consolidating and wiggling around. It means there is nothing. It's just like empty. It's just like water that is not being moved, you need to imagine, right? And then the last one is showing us that the market is pressing down. That means when the very biggest structure shows us that the market goes up, as I said in the beginning, it makes less sense that the market goes down here to these lows, right? But it makes sense at least that the market goes to smaller structure lows like here, but not down here. Because here, as I just said, we have here consolidation phase, and it makes sense at least that the market is touching it, what the market did already. So trading up here, a color switch before the market is touching this area will make sense. This is going to be step number 3. But in step number 2, I want to break down to you these 4 things. So key component 1, seeing lots of red candles then green candles is very important, or green candles then red candles. Key component 2, seeing more length that the market does and move down, as you see here. The market did this length down, but only the 50%, 40% length up, right? As you see here. And again, length up was getting smaller, but the length down was again still more longer. And this shows you that the market wants to go down. And you can see here, majority of candles are here red. Majority of candles are here red. Third component. If you look at all the candles within time, you can see that up here, the market just had a couple of candles, and lower, the market was making more candles, and lower, the market does here a bit less candles, but still more than up here, right? So this is something what's very important. If you combine this and this now, it's definitely more than just in this square, in this price. That means you can see how more candles are happening lower and lower. And this shows us that people want to trade at lower prices, that the market continues. This is a trend following strategy. This is very important. You first let the market push, that it's obvious. Sometimes it is already finished, but there will be plenty of times trading the S&P 500 because this market goes in a trend for 30 minutes to up to 5, 7, 8 hours even, or even 12, what is amazing. In its US session, it's very important. Right now, we are analyzing the market in the pre-session. And what is just very awesome is that we see that the market is trending, and then we start trading down here very close to our target. And then sometimes we can find a push with the high risk reward ratio. The fourth key component is, if you make the chart small at the bottom, is with experience. That means you don't follow too much logic. You follow literally your experience. If you can see that it makes sense that the market goes down here or down here. And from experience, I think the market would go here inside this consolidation phase. It makes sense, at least here to the middle of the mouse. This is trading experience, for example, but I think maybe to the low, but I'm not sure too much about it. Step number 3 is now, and this is the money management, how to lose $75 to make $400, as I just showed you here, right, with the statistic here. And this is with the risk reward ratio, trading tiny color switches. That means, for example, you can see here now a green and a red candle. Sometimes there are double wicks, as you see here. When selling as of now and adjusting our stop placement one tick above, tick is the price measurement. That means I'm going to show you here the short position. Selling here, one tick above the stop placement. And now aiming for this consolidation here, you can find here a risk reward ratio of 4. And if it would reach the low, it would be a 5.5-ish. That means now when pressing on the sell button so much as possible and placing the stop placement here, then it will be adjusted with $100. And this is something what's very important, or like $75. We can calculate that in the S&P 500, for example. It's going to be $12.50 for each position size. And if I made 8 times $12.50, we have $100, for example. We have here stop placement of 2. That means in this case, I would need to sell 4. That means 4 times $12.50 is $50. Okay. 4 times is $50, and then my times 2, because we have 2 ticks, this would be $100, as you see here, for stop placement. That means if I have now a trading platform and it says here on the right side my position size on a trading platform, there's always the please use a demo account, is very important. You have the position size you can select. This is called also the unit of lots, right? That means we need to put this 4, and now you have the sell market button or the buy market button. And then when now pressing the sell market button, actually we would be executed here. It's very important maybe to work with the limit order, it's called. We can just right click there, and then just like on the order book, I'm going to show you this one. And then we can, for example, start placing here, what do you call it? We can start placing here the limit order. So that means, for example, I'm going to show you an example here. When going here to an limit order book, I'm going here into a practice account. You have here on the right side this order book here, for example, and you have your buy market and sell market, as you see here. When going now in the S&P 500, in this case, this is the big one. We go here in the 1 minute chart. That's where we're in here right now. And then when we have a color switch, it means a green and a red candle. Let's assume here, just as you can see, the prices here where the color switch is. When pressing sell market, I would be executed 1 tick at the bottom. That means here where my mouse is. This is something what is very important to understand, because this is also when working with the risk reward ratio, it's more important to work with accuracy. That means measuring from stop placement here to entry here is 2, for example. Now I'm going to select here a 4. I'm going to do right click, limit sell, and place limit sell 4. Or for example, I'm just placing this limit order here and I place it there. And then once the price comes up here, I'm getting filled. It shows me I'm going to sell 4, and then I place my buy stop buy 4. That means now calculated is if the market goes up here to my stop market buy, I'm going to lose $100. But if I'm going to be filled, if I'm going to enter here the market, and then it goes each same time, as you can see, each 2 steps here with the square is $100 in my direction. and up to down here. That means entry here, stop placement there. And when trading now until, for example, down to our consolidation phase or this low here, you can see now there's a risk reward ratio of 6. That means it would be $600 trading to the low of this consolidation phase, and around, like as we just spoke, in the middle to this consolidation phase, it will be $450. So it's around risk reward ratio of 5 if we would adjust $75, but in this case it will be adjusted $100 with a risk reward ratio of 4.5, right? So the third step is, as we just talked about, is to have the color switch. That means the red and the green candle, adjust $100 with the stop placement on the candle, and then the entry after the color switch. I'm going to show you here in this picture a clear example. In this case here, I was trading here the open candle. When having more experience, I think this can be good, because sometimes we see that a candle is closing before it closes. Sometimes you will have 1 or 2 weeks, sometimes even 5 weeks, where you find that there's just a very long green and a red candle, and it's almost impossible to enter the small color switch. You might need to wait like a second week, for example, until you find again smaller color switches, because volatility is being increased. There's a own market for this. This is called the VIX. And the VIX is based on the S&P 500. If you go here to a monthly or daily chart, let's go to the monthly chart, you can see here the volatility index. And when this thing raises above 30, it was here at 70 almost, as you can see here, 65. This means you will have a lot of long candles, and it makes more sense to trade sometimes the 3-minute chart, or just like to hold it out until the market comes back down here at 20-ish, 30-ish, as you can see here, more 20 or 15 here where the market is right now, and then to continue using the 1-minute chart, or like continue trading. When trading, I think it's better to wait until the red candle closes, because beginners get the problem to trade open candles, and then the open candle was red and it was going green, and that this doesn't happen to you so many times. It's literally better to wait for the timer on the right side. It says 2 seconds, 3 seconds, and then on the third step to make the entry. You find here the green and the red candle, as you see here. And very important is here that once the red candle closes, to make the entry, and you can see now that we have slippage by 1 and 2 price increments. I was entering too late because I was hesitant. I would have actually entered here where the blue line is, but I was entering once lower, and this can happen to you when adjusting $100. This could be suddenly $130, $125. That's why, like in the statistics, you also saw like my biggest losing trade here was $130 with leverage. This is something what can just happen. This one was a winning trade, but this just is something what can happen, as what is totally normal. It's just important that sometimes you lose $75, $60, $50 ish, and sometimes you lose then $130. If you get us in a range and your average, you can hold it at $72, as you see here, average losing trades, everything is all right. Just like trading the tiny, small color switch. So entering the trade after the color switch, very important. That means the red candle opens at the top, it closes at the bottom of a color switch. Entry is where the close is, stop placement is at the top. The green candle opens at the bottom for trading up. For red, green opens at the bottom, closes at the top. Entry after the green candle, where the close is, where the candlestick body of the green is at the top side. So the stop placement should be in the opposite side, where the highest point is, the outside point where the wick is, or the lowest point where the wick is. That means when selling, as you can see here, we take now the color white. This is green red. Entry after where the red candle is closing, adjusting $100 to our wick, either the red wick or the green wick from the color switch. Whatever you see, it makes more sense. I like more the tighter stop placements, but there will be many cases where the higher stop placement makes more sense. And when taking a buying signal, that means a red and a green candle, entering after the green candle closes, and stop placement on the color switch, like on the lowest point. That means here the green candle or the red candle if the red candle is shortest of 4. So when doing this 3-step method, as I just said, it means step number 1, identifying the highs and the lows from a bigger and medium structure. You can see here, we have here again here from small, like from very fresh, market pressure short. Medium, the market is a bit flat. And long a bit, you can see how the market goes here lower. From here to here goes lower, right? These 4 key points then by step number 2. And then we go to step number 3 with the money management and the adjustment. And this should work. Please use a demo account first. And I hope this will make you a better trader.